In this video, I'm going to show you the results of a trading strategy which buys after 4 red daily candles and it sells short after 4 green daily candles. And for such a simple idea, the results are surprisingly good. The first test I'm going to do is on pound-dollar Forex pair. However, I have done some brief testing on some other Forex pairs and using the same or very slight variations of the strategy, seen some promising results too. I got the idea for this test or this strategy after reading a very thought-provoking post by a guy in a trading group the other day. And his question went something like this. He said, "How would you trade if you had no past data to test on?" And that got me thinking. The first thing that came to mind was trends. But I typically trade trends using breakouts from certain levels. And if you didn't know about what the certain levels were, as in you didn't have the past data to see those certain levels, then how would you be able to do it? So then I immediately thought about reversals. What happens if the market comes down 4, 5, 6 days in a row? Surely it can't keep going down. There's going to be some sort of a bounce, some sort of a retracement and an opportunity to buy. So I quickly wrote a program which bought after 4 down days or 4 red candles, and it also did the opposite. So it sold short after some strength after 4 green daily candles. If they were the only 2 rules, then that would be a strategy. It'd be a stop and reverse strategy, because an exit from a long position would be an entry into a short position. However, I did decide to include a really simple exit. I'm just going to use a timed exit, and I'm going to say, for example, I want to exit the trade after 5 bars, or in this case 5 days. And of course I included a normal fixed pip basic stop loss. And although the idea of trading with no past data came about, that's fine, but I've got the idea, but now I am going to have to go to my past data to test it out, see how it would have worked in the past, because that's our best indication of how it might work continuing in the future. Here's where I'd normally take you over to the whiteboard and show you exactly how the strategy works. But I think everybody knows what 4 consecutive red bars looks like and 4 consecutive or 4 green bars in a row look like. So I'm not going to bore you with that. We're going to go straight to the computer and have a look at the results. We're going to be looking at the daily chart, obviously, of pound-dollar Forex pair. And I've done 2 different developments. I wanted to limit as much optimization as possible, so we're only going to change that timed exit. So we might say exit after 5 days or 10 days, and we're also going to change the stop loss value. Not a great deal, but we will have a look at what works best. All tests are going to include some costs of $60 round trip, and that's for 1 full lot of Forex. The first development we're going to look at is a walk forward analysis or a walk forward optimization test. And if you want to learn more how I use walk forward analysis, then I'll link the video down below, so take a look at that afterwards. The second development is a simple in-sample and out-of-sample test. So we'll look at data from 2008 through to the end of 2018 and see what works, maybe adjust that timed exit and the stop loss, and then have a look at the out-of-sample data from 2019 through to October 2021 and to see how the strategy continues to perform on the unseen or the out-of-sample data. Let's have a look at the first development. In this first workspace is the results using the walk forward analysis, and you'll see I've only got data from 2012 through to January 2022. Obviously that's the full data. We've only got data on the chart up until October 21. And I can only start from 2012 because the prior 4 years I've used for optimizing. And like I said earlier, if you want to learn more how I use walk forward optimization, have a look at the video that I've linked down below in the description. So let's have a look at the equity curve. And that's the equity curve. And that's pretty nice. Sure, there are some drawdown periods, but it's a really nice uptrending equity curve, especially for such a simple strategy. Almost 10 years, we're making almost $80,000. That's pretty good. Got 114 trades over the 10 years. Average trade is huge at $700. That's really good. Largest losing trade is 5,000. We probably had a 500 pip stop loss 1 year in there. That's the long equity curve, and that's the short equity curve. So they're both working pretty equally. So that's nice to see too. In the next workspace, we'll look at some more data. So we're going to have data now from 2008 through to the end of 2018. That leaves us those few years for out of sample. And actually, just before we look at the first optimization, let's just have a quick look at the trades on the chart. So we've got a few trades here. So the first trade here is enters on the open of this bar, and you'll see that we've had 4 consecutive red bars, and then we enter. The next trade is a short trade here after we've had 4 consecutive green bars. Then the next trade is here after 4 consecutive red bars. Next one here after 4 consecutive green bars. I think you've got the picture. I think you can see how simple this strategy does work. So the first optimization that we're going to do is looking at I've called it the X bar exit, and it's simply saying we want to exit if we're using 5 after 5 bars in the trade, or 5 days in the trade. And looking down the results, I've gone from 0 to 50 in steps of 5 or increments of 5 days. And we can quite clearly see that the highest net profit, and quite stable because we've got decent results either side of it, is using a 35 bar exit. So we've selected that. And in the next optimization, we're going to be looking at the stop loss. And I've gone from using a stop loss of 100 pips right the way through to 600 pips. And looking down the net profit, you can see the best value is at 450, although using 400, the net profit drops off quite a lot. So these more stable areas, I'd rather go slightly larger, and let's call it 500. So we select 500. And let's have a look at the equity curve. That's the short only, that's the long only, and there's the combined equity curve going from a larger date range now of 2008, not 2012, through to the end of 2018. I better mention actually the equity curve you saw before, although it only started from 2012, round about here, it did actually go, if we quickly look at it, it did actually go up to present day. So we have actually got results here up until the end of October 2021. So we're seeing slightly more data in the future than of this equity curve here. But I also noticed that 250 pips, if we just look at the optimization, also noticed that 250 pips also had decent net profit as well, and was reasonably stable. I mean, 200 pips worked, kind of fell off the cliff at 150 pips, that's far too narrow. But I'm just going to select 250 pips and have a look. And there's the equity curve. In fact, it's slightly smoother, but I think I'll continue on with the original 500 pip. Now, this next workspace is using the 500 pip stop loss, but this is using data from 2008 right the way through to the end of October 2021. I'll just show you that. The last bar here is the 29th of October 2021. So now we can look at the out of sample data from the beginning of 2019 through to the 29th of October 2021. And there's the equity curve. So anything from the start of 2019, which is about here where my cursor is. So this period moving forward is actually the strongest period on the chart, and that happens to be the most recent period. So that's great that it's working well into unseen data. Next, I want to show you an alternative exit which gets out of trades quicker, and it hasn't been optimized. Using the current exits, we're average bars in a trade or average days in a trade around 20, and using the exit that I'm going to show you in a minute gets out of trades in an average of about 7 days, so only about a third of the time in the trade. But first, if you're enjoying this video, then do me a favour and please give the video a thumbs up, and maybe subscribe to the channel for more videos just like this one. And if you like this type of strategy, then you might want to download my 22-page Beat the Markets Strategy Guidebook, and it's a free PDF. If you use the link in the description down below, you can get that for free right now, and that includes 3 mechanical or rule-based strategies, a little bit like this one. So if you're interested in that, have a look at the link down below. Continuing on with this strategy then, with the 500 pip stop loss, the 35 bar exit, and this is the full data. Let's just have a quick look. We've got net profit of 106,000, and if we look at the total trade analysis, you'll see that average bars in trade, 18.7, almost 19 bars. Now I'm going to show you a different exit, and you'll notice on the chart I've got this cyan moving average line, and all that is a 10 period simple moving average. And if I switch in my code, now I've programmed this so I can easily switch this, we're going to continue with using the 35 bar exit, but we're also going to use a 10 MA exit, I've called it. So we're going to use that moving average exit, and let's zoom in a little bit. Now we can see that if we're in a buy trade like this one here, just remove this. If we're in a buy trade like this one here, the exit is when the market closes above the 10 period moving average. So you see it's closed above here and we've exited. That was a losing trade. Opposite for short, we've entered here and then we exit as soon as the bar closes below the moving average. Here, this is our long entry and the bar is just closed above the moving average, so we've exited. These aren't particularly good examples of the trades, some of those are losers. We look here, for example, we've had the 4 red bars, we've bought, got the close above the moving average, and we exit. Okay, so we're exiting into strength of the direction of the trade that we're in. Now, here's the total trade analysis. You'll see now we're only in trades an average of 7.2 days. We've got a much lower average trade, obviously, because we're in the trades less. We're trading much more. The net profit is way down. We were just over 100,000 before, but because we're taking the quicker trades now, our net profit is down. And our equity curve it's okay. It's very flat these early years. It seems to have picked up and it's working really well in recent times. Interestingly, on the other pairs that I've tested, this exit actually worked better than what the exit worked on pound dollar. And the last thing I want to do is remove this 10 period moving average exit. I'm going to select the same data range as I had with the walk forward analysis, which was from 2012 through to all of the data. And then we're going to have a quick compare to see what the difference is. So using the regular in sample and out of sample, you'll remember this equity curve. 98,000 and 108 trades, average trade of $914. Now, looking at the walk forward analysis results with the same date range, 114 trades, we've got a slightly smaller average trade. We've got less net profit, and our equity curve is pretty similar, isn't it? So that's quite a nice thing to see. However, when you're doing a walk forward optimization or walk forward analysis, you're adjusting the inputs or the variables for each set of data as we move along. And because of the nature of the variables that we're adjusting, there isn't much adjustment. You'll notice with that timed exit, for example, the best net profit was 35. However, in fact, although it's saying get out of the trade after 35 bars, more often than not, I could have shown you on the chart, but we were actually getting an exit because we were getting an entry into a trade in the opposite direction. So we weren't actually using that 35 bar exit very much. So we could actually remove that 35 bar exit completely and the strategy results wouldn't change that much. It would be more like just a stop and reverse type strategy. So that's why the walk forward analysis and the in sample and the out of sample analysis, they look fairly similar. And of course we have adjusted the stop loss in the in sample, out of sample, it stayed at 500. In the walk forward analysis, it's adjusted for every year. However, we're not making a massive adjustment. We've probably got a range between 250 and 500 pips for each year. And the stop loss between 250 and 500 isn't going to make a huge impact on the performance report. In conclusion then, to me, this strategy is very logical. And for that reason, I hope that the performance will continue into the future. I mentioned earlier that I'd actually tested it out on some other markets too, using the daily timeframes. In fact, let me show you some of the equity curves of the other markets. So here's one, and this one, looking that it's got more trades, this one actually uses that 10-period simple moving average exit. Others, here's another one, and another one. This takes slightly less trades, but you see some flat periods, and the last one. So that's 4 other different Forex markets, all showing some promise. I might even do another video documenting these other 4, and using these other 4 and the pound dollar that we've already looked at, using them in a portfolio might work really nicely. And I think I might have mentioned earlier that I would like to try some different exits too. I'd like to try one of my old favourites, the first profitable close exit, and also try some different time frames, probably the 4-hour being the most obvious one to try next. What do you think about this simple idea? Let me know in the comments below. Anyway, I hope you've enjoyed the video, and until the next one, this is Jared Goodwin, and thank you.